Welcome to Minutes by Board Cycle, where in each episode we pack the insights from one of Australia's boardroom leaders into just a few minutes. In today's podcast, host Richard Conway interviews Mark Johnson, Chair of HCF, Counsellor at the University of New South Wales and Director of Goodman, Aurecon and Sydney Airport Corporation about the impact of an organisation's purpose, members and stakeholders on board decision-making.
Hello and welcome to the Minutes podcast. I'm your host, Richard Conway, and in today's podcast, we're going to be talking about managing diverse ownership or stakeholder groups. Joining me to discuss this topic is Mark Johnson. Mark sits on the boards of a diverse range of organisations, including HCF, Goodman, Aurecon, the University of New South Wales and Sydney Airport Corporation. Welcome to the podcast, Mark.
Yes, thanks for having me, Richard. Great to be here.
Great. So, Mark, I wanted to talk to you about this topic because you're a director or the equivalent on a number of listed companies which have quite diverse shareholder bases, but you're also the chair of HCF, which is a not-for-profit mutual fund, a counsellor of the University of New South Wales, which, as we know, is a major academic institution, and also a director of Sydney Airport, which is a major infrastructure corporation that's privately owned. So these seem like very different types of organisations whose purposes are quite different and whose owners or stakeholders are quite different as well. So to start off with, I wanted to ask you whether you think about your role on the board or equivalent of those organisations as being fundamentally the same or very different.
I think they're fundamentally the same. The major differences, Richard, are around purpose. Some of those organisations obviously have a profit purpose. Some of them are listed on a public stock exchange and the profit purpose extends to retail shareholders. Others are owned by a few large institutions or private equity funds. They have a for-profit purpose as well, but the focus is slightly different to a retail shareholder. And then you move to a mutual where the focus is on your members and on delivering value to members, whatever that may mean. In the case of HCF, it's about helping them navigate their way through the health system and making sure that benefits are paid to the right level, that their premiums are not too expensive. And then you go to a charity organisation. You didn't mention the Smith family, but until recently I was on the board of the Smith family, which, again, the purpose was different there, which is very much focused on assisting disadvantaged children with their education. And so each of those purposes are quite different, and one fine-tunes one's mindset to focus on a purpose. So quite often, if you're thinking about a not-for-profit, it's not for loss. A not-for-profit needs to be governed well. You're not trying to lose money. You're trying to make sure that business is sustainable. But by the same token, you're not having to worry about dividends to shareholders and other things like that. So in the case of the Smith family, for example, we'd be very focused there on how many more children can we serve. So we're serving 100,000 children, say we'd like to make that 120,000. So how do we make that money stretch further? How do we know that the services we're offering are making a real difference in terms of the ambition there, which was to keep more kids in school and have more of them graduate to tertiary education? At the university, it's all about giving a great education to our various students, but also it's about driving great research and being recognised internationally as a great place for research and to learn, because that leads to rankings. And global rankings leads to international student recognition, and that leads to enrolments, which leads to funding and etc. So they differ in purpose. You still need to have great risk management. You still need to have great controls across the board. You still need to have a strategy that's very focused on your purpose and is executed to differentiate you. Importantly, you still need to attract and develop great talent. One of the big changes is you think a little bit differently about the short and long term. If you're dealing with a listed company, obviously you have regular reporting cycles and these things to deal with, and the markets are very unforgiving if one misses numbers. In the private equity space and others, one small period of time doesn't matter the same as a life cycle of an investment. If you're at a not-for-profit, whilst you want to make sure you're not wasting resources and you're spending money wisely, you're not just focused on profit. You're really focused on delivering to the purpose and making sure you've got sufficient resources to continue providing that purpose for as long as you can, obviously, which would mean that you're still spending money wisely, but you're looking at your funding model and a range of other things in a very different context.
Yeah, great. So it's quite clear from that you're thinking about quite a few different and interacting things when you're thinking as a director of those different organizations. And Mark, you mentioned there is thinking about your members. So talking about the concept of members, there's a pretty stark contrast between, say, the members of HCF, which includes representatives of sort of more mum and dad policyholders, and the members of Sydney Airport, on the other hand, who are major institutions. So how does that kind of difference play into the way you make decisions as a director?
Yeah, well, it does come back to this purpose question and then to the strategy. So if you take HCF, the purpose there is very much driven on driving member value. And we define member value as meeting their needs in terms of providing services that help them on their health journey. It means providing them with cost-effective insurance cover and premiums that are market-leading. It involves us operating well so that when they make a claim, we can pay them swiftly. It's all those sorts of things. And whilst a company might be focused on dividends, we're focused on giving value back through better services and better returns on their money through better benefits and lower premiums. So it may well be that the net result is the same, but rather than paying out to shareholders, we're giving it out in member services. In the airport's case, for example, we very have for-profit-minded investors in that case. So it's not so much where they're interested in the delivery of a service to them, because in this particular case, they're investors, not customers. Having said that, obviously they're interested in the airport performing exceptionally well, so that it drives fantastic customer satisfaction and experience on the basis that drives passenger volumes and a related range of things. But those investors are still focused on value and cash flows and things like that. It's different to a public company again, because they're not quite as focused on the day-to-day quarterly reporting, etc. They look at things through a longer-term horizon. They're obviously monitoring results very carefully on a regular basis. But the decision horizons then are, again, a little different to a public company, which has to deliver today whilst building bridges for the future. Whereas some of these other organisations just focus on the future all the way and not so much today.
Yeah, absolutely. And so, Mark, turning to the listed company scenario, even within your listed company portfolio, there's quite big differences in the ownership makeup of those companies. So I wanted to ask you, as an independent director on all of those boards, how mindful are you about the sort of specifics of the breakdown of your shareholder base in performing that role, and in particular about retail versus, I guess, non-retail shareholders?
Yeah. Well, we're very focused on our shareholder base wherever it comes from, and that's the case in any of these organisations. In public companies, we do keep a good eye on the register, and as you know from past experience, Richard, we're speaking very regularly to all our shareholders. We get round the big institutional shareholders a couple of times a year. Obviously, we're very conscious of our obligations to keep the market informed. So, and then we obviously are talking to all shareholders, I suppose, through our half-yearly reporting, and particularly at the AGM, and through releases and presentations we do all the time. So, bigger shareholders depending on how big their shareholding is, may have a bigger say, and they normally would have that say through a seat on the board, for example, or things like that. But after than having a seat on the board, we essentially treat all shareholders very much the same, as you'd imagine. And we are very focused on returns for retail shareholders, acknowledging that at the end of the day, we work in the interest of all shareholders, and we've got to drive to the purpose and strategy of the company for the long haul whilst delivering for today. And individual shareholders will have individual perspectives on strategy and a range of other things. And I suppose they appoint a board to work through all the different options and ways in which a business can succeed. And whilst we listen to every shareholder, ultimately we have the skills and experience on the board to try and find the best path to create value for all shareholders.
Absolutely. And then lastly, Mark, I wanted to ask you maybe a tricky question about organisations like the University of New South Wales and Sydney Airport. So beyond the organisations themselves, I guess they make up a part of our kind of societal or economic infrastructure. Yeah. And so the decisions that that you and the other directors are making can have implications for quite a broad number of stakeholders over quite long periods of time that could be quite hard to predict as well. And so I was interested in asking you how you grapple with those kind of broader effects to broader stakeholders when you're thinking about that as a director.
Yeah. We're obviously thinking about broad, not just of those organisations you mentioned then. We think stakeholders much more broadly. So this traditional view of a company just focusing on its shareholders, the days where you just did that, if they did exist, are well and truly gone. I mean, you only succeed, you can't be a success in a failed world. And so at every organisation, I mean, not just the university, the airports or others, we're all very focused on sustainability in a broader context and broader stakeholders. So that includes our employees, local communities, customers, obviously, our shareholders. So our community view is very broad and our stakeholder assessment is very broad everywhere. And whilst there are always trade-offs on those sorts of things, our ambition is to make sure that we're a good corporate citizen and we work strongly in all of those areas. And clearly, if a profit organisation, you've got to try and meet the profits. But I think the long-term view is if you don't have your other stakeholders happy, that may jeopardise your long-term profitability. So you just can't ignore any of those things. So we have regard to all of those things as we're thinking, and there are trade-offs that one's making from time to time in all of those things because you can't do it all. But you decide what's most important and you try and deliver appropriately for your shareholders and for all the other stakeholders.